Hi, this is Shawn Hyde of Peak Business Valuation. Welcome to Basic Business Appraisal Factors to Consider. So, in this particular analysis, I just want to point out a few things that many folks who have not worked in the business valuation industry may not be aware of. For example, have you ever heard of Revenue Ruling 5960? This was the IRS's basically first guidebook for business appraisers. Originally, it was put together for estate tax purposes, but since has been applied to a wide variety of business types of different valuation work. It was written in 1959. It includes the definition of fair market value, which is the price at which the property would change hands between a willing buyer and a willing seller when the former is not under any compulsion to buy and the latter is not under any compulsion to sell, both parties having reasonable knowledge of relevant facts. Court decisions frequently state, in addition, that the hypothetical buyer and seller are assumed to be able as well as willing to trade and to be well informed about the property and concerning the market for such property. Whew, that's a big mouthful. A little bit more on that as well. The definition of fair market value comes down to this. It's a hypothetical construct, doesn't actually exist. In real life, it doesn't. When was the last time, those of you who've worked with business buyers or sellers, when was the last time somebody sold a business who did not want to sell it, was not motivated in some form or fashion to sell? It just doesn't happen. 5960 talks about a bunch of different factors that business appraisers should consider in each assignment they work on. And it provides some of the very first instructions that business appraisers have ever had on how to do this job, right? So here's some discussion right here. There's a difference between publicly traded companies and privately held companies, right? So publicly traded companies, you can look up the shares of their stock, what they're appraised for on the exchange. You can, and they change, all the time, but you can look them up and see it. Privately held companies don't have that. So there's really no established quote unquote market or exchange for stock or shares in a privately held business. Therefore, there's a bunch of other analysis that has to go into it to figure out what would be the value of those types of shares. So there really is no formula that says you follow this path and this is how you get there. 2 plus 2 does not always equal 4. In business appraisal, well, the math is right, but there's reasons why you might look at different things. There's all kinds of facts to consider. I mean, the value of a business is going to be based on the income the thing generates. Well, what if somebody's paying themselves as the owner an excessive salary? So their profit's $100, and value of $100 times whatever multiple gives you a number. But that's not going to be correct because if it's an excessive salary, let's pull back to the fair market value definition. There needs to be, what would be a relevant what would a relevant, knowledgeable, willing buyer and seller agree makes sense to be the salary to pay somebody to do that job. If the salary is excessive and you make that adjustment, now the profit's, $10,000. There's some adjustments there to the math, right? You have to take into consideration all kinds of these types of different factors and how they might impact the overall valuation. And the fair market value of a company is going to change based on the expected future outlook for the economy, the industry, what's going on with other choices the company itself is making in its business model. Like the thing says here, from normal to boom or depression, shares of stock will have a different value depending on what's going on for the various outlooks. Speaking of outlooks, stability or lack thereof of expectation of future continuity will also have an impact. The more risky an investment in a business is, the lower the value is going to be. And the appraiser has to exercise judgment as to the degree of risk that you're going to attach to that analysis. So you have to consider all the other factors that you're looking at, but there's no real chart that you can point out and say this is the final risk rate to use. It's all appraiser judgment. And this is my favorite quote. Valuation of securities is, in essence, a prophecy as to the future and must be based on facts available at the required date of appraisal. So as of our effective date, what do we know? What could be knowable as of that date? Do we know that the business is going to land a large contract? Maybe not. But we do know that we've bid on one. So there's some uncertainty there, right? And the basic math is value is equal to expected future income divided by a risk rate. So if we know what the future income is, and anybody who has a crystal ball will know what that future income is. Most of us don't. We have to look at the information that's provided, that we have access to, and say, okay, what do we can analyze historical analysis stuff to see what has happened. We have to try to predict the future. And then what's the risk of that income continuing on into the future, right? So there are factors to consider. Here's that thing I talked about earlier on. 5960, Revenue Ruling 5960 lists these 8 different factors. And if you're reading somebody's business appraisal report and they don't talk about these or mention these, that's a red flag. You got to pay attention. These factors need to be addressed. It's how you gain an understanding of the business that you're appraising and how you run through the whole process. So if you don't know what kind of a business it is that you're appraising, the nature of the business, I think you have a harder time finding appropriate market comps and analyzing risk and doing your benchmarking. History of the enterprise. From its inception, you really want to know how the business has changed. For example, the NAICS or an industry classification code that shows up on a tax return. Oftentimes, the accountant who first prepared the tax return looked up the business classification code when they first set it up 20 years ago. And if the business has changed over time, maybe that NAICS code is no longer appropriate or applicable for the company you're appraising or that's being appraised. We have to consider the economic outlook in general. What's happening in the overall world or country. The valuation of a corner coffee shop, we don't really care about so much about the trade imbalance with China. But we do need to know, what's happening in the area that would affect that corner coffee shop. In the industry, are there technological changes that are happening? And if businesses are not keeping abreast with that technological change, are they going to be left behind? Will they become more risky as an investment? There's some factors in how they might impact the analysis that an appraiser is putting together. The book value of the stock and overall financial condition. Is there debt on the books? How much debt? How does the overall financial ratios of the company compare to industry averages? Is the company operating such that it's a stronger operation than the industry average? Or maybe it's weaker? Could be similar to, but that's going to have an impact on risk analysis. The earning capacity of the company. I have an awful lot of fun when I see people saying, well, the company generates $1 million in revenues, therefore it's worth $1 million. Yeah, what if it's losing $500,000 every year? Do you still want to pay $1 million? It depends. There are some factors that might make it worthwhile, but those are far and few in between, right? Especially for privately held businesses. Factor number 5, the dividend paying capacity. People tell me all the time, but Shawn, privately held companies rarely pay dividends. I say, I know, they don't. However, if they were going to, what would be their capacity? How much dividend could they pay? What is the amount of cash that could be removed from the company without negatively impacting operations? This becomes important for some of the various techniques that are used to generate through cap rates, your risk rates, to come up with the value of the company. Does the business have goodwill or other intangible value? Sometimes they don't. There's a whole another video we can talk about on just goodwill itself and how determining whether it exists or not. Sales of the stock and the size of the block to be valued. So has the company sold shares to a third party in recent time? We can use that as an indication of value. If it was at arm's length, and the company hadn't materially changed in between that sale and what it is now. But how big of this block are we going to be appraising? Are we going to be appraising 100% control interest? Are we going to be appraising a 2% interest that does not have any control? Or on the other hand, a 2% interest that owns 100% of the voting stock? All those things have an impact. And then what are other similar businesses trading for? Now, back in 1959, when the IRS wrote this up, The only market that existed was the public market, really. Nowadays, we have much more data for the privately held enterprise. We have databases where business brokers contribute information on transactions of privately held businesses that we can access in order to look at and see how they compare with the subject that's being appraised. But again, you got to look at, so there's a wide variety of multiples that are being used. Just because, well, in restaurants, for example, you can see restaurants that are selling anywhere from 0.3 times revenues to 2 or 3 or 4 times revenues. Well, that's quite the range. What's involved? Well, some of those restaurants are being sold in addition to the business. The real estate is also being sold. Some of those businesses are distressed. They have highly motivated sellers. So there's different factors to consider, to think about when you're looking at picking a specific multiple to apply to the business in question, and trying to come up with a value for that. And then same or similar line of business is important, because we don't always have perfect comps. We're going to find something that's at least moving in a similar direction. One of my favorite examples is a court case involving the state of Hall for Hallmark. One appraiser said the only comp that exists is American greeting cards. Another appraiser said there's a variety of other companies that we can look at. I think Avon, Anheuser-Busch, I think Coca-Cola was also selected as comps, because what Hallmark is not just a greeting card company, it's a distributor of products over the world. Therefore, they could use those other businesses as comps. So it worked out. But again, same or similar line of business is something else to keep in mind. Now, there are two types of privately held business that can be appraised. There's those that are holding companies that exist in order to own and hold some other asset. It could be real estate, it could be stocks, could be cash, it could be interest in other companies. The value of those types of businesses are going to be based specifically on the underlying assets that they hold. So you might need real estate appraisals. You might need appraisals of other businesses. I've had one where we need to look at what the value of the gold that the thing had was. We had to have their other statements. You might hold marketable securities in the public stock market. What are those worth as of our effective date? Now, the other one is operating companies, the ones that are selling goods or services to the public. They generate an income, a return on the investment of the business's owner. Now, if some of those businesses, the return, the ROI, is material and positive and very useful, and can use that to generate value. Some of these, however, have an ROI that's very small. Some of these businesses just don't generate much in the way of profits, in which case some of those may also be simply just appraised based on the value of the fixed assets that they have. Again, it depends. Cap rates. The risk rate that we have to derive under the income approach, determining that, this is what 5960 says. This is one of the most difficult problems in valuation. I mean, there are methods that we can use to look at it, but not all methods apply to all types of businesses. And then there's some businesses don't have, when we have their financial data, we don't have balance sheets. Therefore, it's very difficult to look at like changes in working capital, changes in fixed assets, changes in debt amounts, things like that. And there really is no real simple way to just point out and say, here's the rate of return that we need to see. I mean, if you look at the major exchanges, you see that's a wide variety of stock prices and businesses, even in the same industry. So those are some other big issues. And here's one that's interesting. One of the most commonly used softwares that I've seen people use for business appraisal will list, 7 or 8 different valuation methods. And then they're all over the place. One says 144,000, one says 8.7 million, one says, all over the place. And they take a straight average of all of that and say, here's the indication of value for that business. You got to have some judgment. You have to have some thought. There's different factors to consider. So if one valuation method says 144,000, the other one says 8 million, something's missing or something's being misinterpreted. So that's hard for a computer to figure out still. Those free services online that you can look at to generate a value for a business, those algorithms are going to be pretty basic. They're not going to be able to consider all of these different factors. You got to keep that in mind. Yeah, no useful purpose. So that's my brief, quick discussion on some factors to consider in appraising a business. If you have any questions, give me a call, send me an email. There's my information.